Hello and welcome to Budget Insider. Joining us today to decode the Union Budget 23-24 is Dipti Deshpande, Principal Economist at CRISIL, and Hetal Gandhi, Director Research at CRISIL Market Intelligence. Thank you for joining us today, both of you. My first question is what are the hits and misses of this budget this year? If you'd like to go, Deepthi, first.
Sure, Malini. Thank you. Thanks for having me here. I think it's not very often that we tend to say this, but for this particular budget, I'd rather say that there are more hits than misses. From a macro perspective, there were just two or three key asks. One was for the budget to support growth. The second, that despite supporting growth, it should continue onto the path of fiscal consolidation, and then, of course, also push some effort towards green transition. So I think on all these fronts there are ticks, and therefore I'd say there are more hits than misses. Of course, there could be the usual ask of having a bigger push to consumption support, giving a big push to the rural areas, etc. But I think the situation and the environment, etc., is pretty tight from a fiscal perspective. So within that, whatever maneuvering was possible, I think they managed to do that.
Hetal?
Yeah, I think I agree with Dipti in a way. There are many positives or tick marks which we have been able to, have as a part of the overall budget spending. But something that really strikes a chord with what the government has been targeting is the kind of infra spends which have been promised by the government. If we look at 11 key ministries, which CRISIL tracks very closely, government support through gross budgetary support and IEBR, which is nothing else but borrowings which would be done by public sector units in those specific sectors, you will see that there is a strong growth of around 24% over actual spends that you saw in fiscal 23. And this, I think, is one of the biggest hits of the budget. Uh, 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 Also, if we look at the kind of spending that is being done, direct allocations from through gross budgetary support are much, much higher than relying on IBR, which in a turn also speaks about the transparency with which the government is wanting to spend in the budget. So both, I believe, are steps in the right direction. If we look at the other part, there are specific core sectors where spends have gone up substantially. So, of the total 8 lakh crore plus spends of these 11 ministries, you see that there are large allocations happening to Ministry of Oil and Petroleum. That is mainly for green energy transition, almost 30,000 crores being allocated over there. A significant increase, almost 35% increase in allocations which are happening to roads ministry. And followed by that, you have power and renewable energy, which is a focus area. So these three ministry allocations clearly are core sectors from an India standpoint, and continued allocations over there is a very, very important move. Railways also continue to show a pretty strong increase, accounting for the remaining incremental spends that the government has promised. And that, I believe, completes the package in terms of, multiplier that each of these sectors have with a link to GDP, and also the kind of employment generation that one would see with the allocations happening to these ministries. If also we look at private capital expenditure, we are seeing that PLI linked incentive allocations are going up. There is almost 11,000 crore allocation that has been done to PLI linked incentive payouts, and this is almost 2x, a little more than 2x of the spends that the government did last year on PLI linked incentives. So that is also going to push continued private capex in the sector. um, I believe both from a PLI standpoint as well as overall energy transition standpoint, the market was expecting a little more. So, for example, CRISIL's estimates on PLI indicate that if all would have been good, almost 24,000 crores of incentives should be have been doled out in FY24. Now, while we are seeing significantly higher allocations from the government, they are still half of CRISIL's initial estimates. What this indicates is that there is a kind of a delay in PLI execution itself, and also invoice verification, which is an important step before incentives are being paid, is also taking time, which in a way is slowing down the pace at which private capex would actually grow. So that will continue to remain a monitorable. Second, the market was buzz with, strong push towards maybe a PLI too for specific sectors which continue to need support. Electrolyzers, for example, was one such sector where a support was expected. However, nothing has been done on that front, so that also will remain a monitorable if government is looking at doing some announcements on that front as well over a period of time. But that has clearly been something that is not being addressed in the budget. To be specific, with the 19,500 crore that is allocated today to the green hydrogen mission and reduction in open access charges, which the government has already done at a central level, we will still land up at around $1.7 to $1.8, 1.9 for green hydrogen costing. And a lot of international counterparts are already talking about $1 to $1.2 kind of a costing. So, how do we bridge that gap is going to be very, very important to have a real benefit of the 5 MTPA target that the government has set in. So I believe, this summarizes focus areas as well as misses from a government standpoint.
Deep, if you this growth versus this entire inflation and budget dynamic, actually given the expenditure, expect growth to pick up.
See, honestly, if you look at our forecast for FY24, we are expecting GDP growth to come down to about 6% from 7% of this year. I think to understand whether the budget will make a difference here, it's important to look at what are the factors which are pulling growth down. Number one is the fact that we've gotten over time a lot more integrated with global cycles. So, with global slowdown happening at a rapid pace, expected to happen at a rapid pace in this year, that's naturally going to pull down growth for us. The second thing that's we are keeping in mind is that interest rate transmission from the recent hikes in repo rates is going to start getting faster now, and that will start hurting at least some segments of the economy and hurt growth there. And finally, the third factor is that FY23 saw this benefit of a one time lift effect that a number of contact based services such as travel, tourism, etc. Benefit. Now, once that one time lift effect starts fading off, that's another and the third factor which is going to bring down growth. So, I think these are going to continue, and therefore, growth is expected to be slow. Having said that, the big push that has essentially come from the government in terms of supporting capex through its budgetary sources as well as by nudging central public sector enterprises to spend is definitely going to act as a supportive measure. It may, however, not be enough to prop up growth from our estimate of 6%. And the simple reason for that is the spending, as we understand, is a more capex led, investment led spending, which takes time to seep into the economy and then yield growth. It's not like a consumption led spending per se. So it will support growth in some quarters, like Hetal rightly said. There are some sectors like roads, for instance, where it will create employment and bring in a supportive impact, but it's not going to nearly have a big impact on growth in the next fiscal.
Right. Itself, Dipti, do you see the fiscal math playing out properly and as projected, the glide path to and by FY26? Do you see that achievable?
Yes, I think we do. So honestly, there was a little bit of worry that several quarters in the economy had this time around because firstly, we are just about 3 years away from achieving that below 4.5% to GDP fiscal deficit target. And had we chosen to stray away from that target this year, it would have made it that much more difficult in the terminal years to achieve it. So we're definitely working towards it, and I think it's going to be a lot more realistic getting to that target 3 years hence. Having said that, for FY24, at the moment, the fiscal deficit target, the way they're planning to achieve it, looks realistic, but it's not without its fair share of risks. So, for instance, number one, on the revenue side, the nominal GDP growth assumption of 10.5% that they've made seems realistic. Our own assumption is that GDP growth in nominal terms will be around 10.5 to 11%. Second is their assumption on tax buoyancy, which is also fair. They are expecting it to rise to levels which were seen pre-COVID, in the decade prior to COVID hitting us. So I think to that extent it's fairly reasonable. But I think the worry, honestly, is on two accounts. First is the disinvestment target. Already last year's or the current year's budgeted disinvestment target was pretty low. We've achieved much lower than that as per the revised estimates. And the actuals so far are, in fact, 20,000 crores less than even those revised estimates. So now a budgeted number which is similar to this year's revised estimates is at this moment a steep target to achieve. So that's going to be a number one monitorable. Second is that there is huge dependence on lower subsidy bill to basically achieve that fiscal deficit target. Our base case does suggest that we'll be able to cut our subsidy costs on food, fuel, and fertilizer. But it's also important to remember that one out of this is fairly under our control. That is the food subsidy bill. But fuel and fertilizer is completely, exposed to global shocks. And if, God forbid, something like last year happens, if some sort of a global shock revives in some ways, it could completely throw our fiscal math in ori. So I think the government is also going to be mindful of that. That's certainly not in the base case that things would go off, but it's something that needs monitoring.
Right. This, giveaway of 35,000 crore through tax breaks, increased expenditure, get a leg up, and do you see a pickup? Do you see it giving a boost to growth? Do you see benefits flowing too?
To be honest, we are not really worried about the 35,000 crore giveaway because, like I said, in the base case, there is an assumption that the subsidy bill is coming down. So that definitely creates that much room that's available. Interestingly, like I said, a large part of the reduction in the revenue spends are going to be diverted towards capex, some of it, and the rest is, of course, towards reduction of fiscal deficit per se. In terms of a consumption boost, it's not so worrisome from an macroeconomic perspective. The government is mindful that it doesn't want to, fuel inflation in any way. There will be some benefit, of course, especially to, lower income households, and that could spur spending in some of the lower ticket items, those that especially have not been able to, revive during the COVID hit or immediately right after that. But from a very broad perspective, we don't see it having a material impact, neither in terms of growth nor in terms of inflation at an overall macroeconomic level.
Got it. Hey, what sectors do you see benefiting from this year's budget?
I think most of the industrial sectors will start seeing benefits because there's going to be direct capex spending that is going to happen. As I mentioned, roads, railways, oil and gas and power. All of these sectors have an influence on base metals like steel, cement, aluminium. So, for instance, in railways, allocations towards wagons has gone up substantially. Almost 35,000 crores is being allocated for wagon procurement, which is in line with government's target or agenda of having some 500 odd new trains which they are going to launch. And in line with that, most of these would consume flat steel, and therefore you can expect sectors like steel to benefit with the kind of railway spends that we are talking about. Similarly, I think road spends, large proportion of the new roads which are coming up are seeing diversion from bitumen to cement, and that can have an impact on cement demand. Further, infra overall spends also has a significant impact on incremental cement demand. Government's allocations towards schemes like Pradhan Mantri Awas Yojana, also urban infrastructure. All of this will result in higher consumption of both steel as well as cement. So on the industrial side, you can see benefits on that. Then there are companies which are in manufacturing of specific product categories which get consumed by these sectors, especially on the railway side. You will see benefit on those engineering firms as well. And of course, you are seeing a lot of spends which are happening on the power side of it. Almost 35% increase in allocations to renewable energy ministry, and around 19% increase to Ministry of Power. This is mainly spread across, the RDSS scheme, which in turn is set to have a spiraling impact on state spends on that scheme, and as a result of which you can see transmission infrastructure set to pick up. So combination of this will again benefit segments like aluminium, if I have to say so. So I do believe that clear benefits for steel, cement, aluminium, anything in the metals and the commodity space should see a benefit from infra spends which are expected to pick up.
Super. Growth estimates, the economic survey projects growth to be between, 6 to 6.8 given the rate cycle in developed markets is not yet done with. What kind of growth are we looking at? What kind of growth estimates between 6 and 6.8? What's your view? Are you being optimistic?
Well, honestly, not if you call that optimistic. Our growth number or our growth estimate is at about 6% for next fiscal, coming down from 7% this fiscal. And the growth drivers, or rather the factors that are pulling down growth, are, like I said earlier, global slowdown, which has an impact, higher interest rates that would affect some segments of the economy, and finally some of the one-time base effect that's seen in contact-based services wither away over the next couple of quarters.
Do you expect private sector capital expenditure pick up? Because there's a huge likely to happen. Do you really expect that corporate India is ready to spend given that the sharp and also unpredictability as far as growth is concerned?
Yeah, I think I'll comment a little on that and then hand it over to Hetal, who can provide more details. I think from a very macro perspective, we've been looking at how fixed investments in the economy have been moving in the last couple of years. The NSO's estimate also did suggest that they have been picking up pretty well in the last 2 years. In fact, if we look at the pre-COVID trend level and where fixed investments are today, it's actually interesting to see that fixed investments have recovered faster compared to overall GDP. But most of that has in fact been led by government spending. But that's not enough, you see, because government spending at the end is just about 30% of overall fixed investment spending in the economy. You do need private corporate sector to come in and invest. And while Hetal will pour more light on that, I think it's important to understand that they are in the right frame of mind, perhaps, to invest, in the sense deleveraged balance sheets, banks being more willing to lend, etc. But uncertainty on ground, perhaps better demand prospects, and a couple more other things that Hital will elaborate on, are keeping them away. There is some movement here, but I think from a macro perspective, we'd want them to come back in a bigger way. Over to you, Hital.
Yeah, I think the T is bang on. If we just look at actual numbers that get reported, there is clearly a dichotomy that you see in private capex trends. So, for example, some 500 odd industrial companies. If I look at the H1, which is first half numbers for fiscal 23, their balance sheets indicate that investments in fixed assets has shown a very good increase of around 25% in the first half. This is clearly a sign. But if I go a little deeper and I look at the sectors which are driving that, is it spread across sectors? Answer is a no. You will see sectors like pharmaceuticals, chemicals, areas linked to energy, where capital expenditure has picked up. Some of the industrial sectors like cement and steel, where also larger players have started adding capacities, and clearly capital expenditure has started happening on that front. The second part is sectors which are PLI linked, where incentives have been provided by the government. Pharma chemicals are the front runners. Electronics is the front runner. You will now start seeing investments happening on the solar module or the battery side of it. So there is a pickup and hope over there as well. But old economy sectors, especially on the consumption side of it, both products as well as services, there has been a staggered recovery. You saw faster recovery in industrial sectors like cement and steel, and larger players gain market share. So now they are, with good utilization levels, spending on capex. But if you look at sectors like commercial vehicles, or you look at airlines, or you look at hotels, and you look at their capacity utilization levels, you are still not reaching the pre-COVID peaks which were there, and therefore there is a wait and watch stand that we are seeing from those players, and we are not seeing significant capital expenditure coming on that side. So just as the recovery in demand is staggered, you are also going to see capex growth, which is, or the recovery that is going to be staggered in nature. And clearly, there is a push because of PLI, with PLI accounting for almost 15 to 20% of industrial capex that is happening in the country. But we are not seeing an overall rounded capex that is happening. Yes, another trend that is happening is, if you look at banking wholesale growth rate, which is an indicator of term loans which are being given to corporates, the growth is pretty muted in FY23. What it indicates is, despite of a 25% increase in capex, you are seeing only a 4% increase in wholesale loans. That is because players do have significant amount of cash in hand, which is then getting used to actually pay off their debt, or use in whatever capex is happening, and you are not taking incremental debt. So in a way, positive sign, because you are continuing to maintain good balance sheet strength while you are spending on capex. So yes, mixed trends, not complete recovery, but there are clear positive signs in terms of the overall capex story.
Green shoots, basically.
Yeah.
Deepthi, what about rural been suffering since the outbreak of the pandemic? Rural has not recovered. Income levels have impacted. How do you see rural recovery?
See, honestly, I do agree that during the pandemic, it was perhaps the rural areas which were hit harder. One of the bigger reasons why there was a bigger hit was they had a lot of influx, migration, etc., that did come by. But it's also true that through the pandemic, the kind of schemes that the government had in place, especially focused on rural housing, creation of rural roads, etc., they ensured to some extent that there was employment generation that got created there. I think, in my view, the bigger hit essentially was not really employment or jobs or income. In recent times, the bigger hit there also came in because inflation rates were much higher in the rural areas compared to the urban areas. As a result of which, it would have hit their purchasing power. Over time, what is being understood is that, especially in the last fiscal, with contact based services doing better, a larger part of them prevailing in the urban areas, there would have been reverse migration, or rather, people coming back to urban areas so as to get jobs in these areas. So I think if you look at the budget is probably also pretty mindful of that, and therefore you do see relatively lower allocations for some of the rural focused schemes this year, in the upcoming fiscal compared to the current fiscal. So that could be one of the reasons that they perhaps believe that the rural areas don't quite require the kind of support that they did during the pandemic. After all, a large part of this fiscal consolidation is also dependent upon normalizing of the extra spends that got done in order to provide comfort or cushion against the pandemic.
Right. What will recovery, Hetal? Do you expect rural to recover?
Yeah, so from a budget standpoint, if I look at it, I would say that it will be more a recovery that will happen as, jobs get created with more roads being constructed. But if you look at schemes which are linked to rural areas, or, rural focus schemes, we can say there is Pradhan Mantri, the MREGA scheme, then there is PM Kisan. You also have irrigation scheme where allocations happen from the government. All these are very rural centric schemes. And what you see is in MREGA, your allocations have actually gone down. You had allocated 79,000 crore last year. You did not spend that much. And for FY24, your allocations are lower at around 60,000 crores. You look at the irrigation scheme of the government, you are seeing allocations going down. You look at, PM Kisan, again, allocation spends have been lower and allocations continue to remain stable. Pradhan Mantri Gramin Sadak Yojana, which is again directly rural, their 19,000 crore allocations have remained absolutely stable. So if I add up all the schemes, you will say, either there is a flattish trend or a marginal dip in the total allocations which have been done in specific rural centric schemes. So, not too much of support, except for, areas like Swachh Bharat, where, allocations have gone up, but in terms of absolute amount, that allocation is much lower at around 5,000 crores. So I believe that, general momentum in the economy, with, jobs created because of construction activity that is taking place is something that will trigger employment, which in turn may provide support to rural areas.
Coming back to my last question now, which is rate cycle. Are we done with the rate cycle?
So, Malini, I think in the upcoming policy, we're expecting at least another 25 basis points rate hike. And it might seem a bit odd now that inflation has entered the RBI's comfort zone. It's below 6% after hovering above it for several months. But I think there still are about two, three things that are worrying the central bank. Number one is the fact that although it's coming down, a large part of the decline is on account of fallen fruits and vegetable prices. So if you take that out, then inflation hasn't really come down as much. The second thing that's worrisome is if you look at core inflation, that's still significantly above 6%. And we all do understand that that's the most difficult to really bring down. It's one of the most rigid components of inflation. And when you look at the surveys, etc., they go to tell that manufacturers are still not done passing on their higher input costs. So that basically means that inflationary pressures on core inflation could stay. If there is a wage spiral that could seep into higher inflation. So that's the second thing that's worrying the central bank. And the third thing, of course, is while we're an inflation targeting bank, we target our own inflation, and what other central banks do don't directly influence our decisions on rate hikes. But in this scenario where other central bank actions are having an impact on our currency, causing it to depreciate, causing imported inflation, etc., to go up, I think the RBI would definitely be mindful of that as well. So the overall understanding is that as of now, they're going to raise rates by another 25 basis points. But what's also important is kind of to make the transmission cycle a lot more effective. So of the 225 250 basis points rate hike that they will have overall, not all of that has been passed on to lending rates in the economy. So they're going to make, they've continuously been doing that. They're not just raising rates, but they're also managing through liquidity management, etc. So I think a mix of both of these will be what they do over the course of the next couple of months.
Right. Any closing comments, Hetal, from you?
Yeah, so I think a pre-election budget and a post-pandemic budget. It was a unique situation to be in. We do believe that government has been able to do a good blend in terms of triggering or continue its push towards public investments while private investments are catching up. They have also given some kind of a push to private investments by ensuring that they are keeping allocations on the PLI incentives as a part of their books. And, their role or the path that they have set out on energy transition under COP27 is something where they continue to support via, allocations for green hydrogen and energy storage linked policies. So I believe these three sum up the essence of the budget, and they are steps in the right direction.
Super. Thank you so much for joining us at Business Insider. Thank you both for giving your views on the budget. And fingers crossed, hope for the best. Let's hope that everything plays out as far as the government has planned. Thank you so much.
Thank you, Malini. It was lovely interacting. Bye.